Welcome to the Deep Dive. It is Friday, December 5, 2025. This morning, the market sentiment is, well, decidedly neutral. We're sort of hovering near some key technical resistance. So our mission today is to cut through all that noise, the superficial headlines, and really analyze the critical structural dynamics. We're talking about the actual plumbing of the market that will dictate institutional moves today.
Exactly. When you get this kind of neutral, coiled environment, the big macro headlines, they really take a back seat. Alpha generation comes down entirely to structural factors, things like liquidity, the volatility term structure, and correlation shifts across the big indices, ES, NQ, RTY.
Okay, so we need to find where the opportunities are.
And more importantly, where the fragility lies. That's what the overnight session creates.
So let's start there. Segment 1, the microplumbing. We need to understand the immediate landscape. For the big institutional players, what are the non-negotiables they're looking at in pre-market liquidity?
It really boils down to the capacity for clean execution. That's it. We scrutinize the bid-ask spreads and the depth of the order book.
The level 2 data.
Precisely. Tighter spreads, a deep book that signals robust liquidity. It means you can move massive size efficiently.
And the opposite is a red flag.
A huge red flag. Widening spreads, thin books, that's a major caution signal. It means even a moderate bit of flow can cause an immediate and, an outsized price dislocation.
But not all the flow is visible on the lit exchange.
Right.
Beyond that level 2 data, we have what you call the opacity factor, the dark pools. What do we need to account for there? They handle some of the biggest orders.
Dark pools are absolutely vital. They reveal institutional intent away from the public eye. So we're looking for unusual concentrations of non-displayed volume around specific price thresholds.
So like a buildup of hidden orders.
Exactly. A sudden spike in dark pool volume, say right beneath a major support zone, could signal institutional accumulation. They're buying without tipping their hand.
And on the flip side,
conversely, high volume near an overnight high suggests distribution. They're selling into strength. These are the hidden signals of positioning that really tell you if the market is ready to move.
mapping that liquidity also requires identifying our tactical reference points. We always look at the overnight highs and lows, but you use those to calculate the implied opening range. How does that calculation go beyond just the simple futures extremes?
It's a necessary adjustment. You start with the overnight futures extremes, of course, but the key step is adjusting yesterday's cash closing value based on the difference between the current futures value and its theoretical fair value.
Okay, theoretical fair value. What are the primary inputs that shift that number so much?
Fair value just ensures we're comparing apples to apples. It accounts for prevailing interest rates, estimated dividend payouts, and the time left until the contract expires.
So it's basically the cost of carry.
It is. For example, in an environment where interest rates have been rising, the cost to hold that futures contract changes. So this calculation gives us a much more accurate and institutionally relevant estimate of where the cash market should open, rather than just taking the raw futures price.
Now, that structural adjustment really dictates the starting line. Now, let's shift to segment 2, because this is where it gets really interesting. We're talking about market behavior, structural fragility. Let's start with microstructure, this idea of trapped traders and liquidity grabs.
Right.
Why do institutional whales deliberately push prices beyond obvious technical levels just to reverse right away?
It's an intentional, purely tactical maneuver. It's designed to satisfy a large order without, driving the price against themselves.
So they need to sell, but they can't just hit the bid.
No way. If a whale needs to offload, say, 10,000 ES contracts, they can't just dump them on the lit exchange. They'd crash the market. So instead, they push the price momentarily above a known resistance point.
Where they know the stops are.
Exactly. Where they know stop-loss orders, buy stops are clustered. That little excursion triggers those buy stops, flooding the market with temporary counterflow. In this case, a rush of buy orders.
Ah, so they're creating their own liquidity.
They are. The institution then uses that momentary surge in buying liquidity to efficiently execute their massive short order, and the price immediately snaps back down. The smaller players who are stopped in on the breakout are now trapped, holding a long position that's already underwater.
Wow. So how do we spot that maneuver in, say, the first 15 minutes of trading?
You look for three things. First, sharp wick rejections at those key levels. The price was quickly and forcefully rejected. Second, a massive spike in volume that has absolutely no sustained follow-through. It was a one-off event.
Not a real breakout.
Not at all. And third, the price has to quickly revert and settle back inside the prior trading range. A sustained breakout needs sustained volume, not a single flash.
That's a fascinating look at the tactical side. But let's zoom out to a far more concerning structural issue. Liquidity at the systemic level. We've seen this undercurrent of concern about overnight funding stress. What's the big institutional grade factor that complicates a simple bullish story?
We are tracking the financial plumbing, specifically the Secured Overnight Financing Rate, or SOFR, and the Tri-Party General Collateral Rate. Both have been creeping persistently above the Federal Reserve's upper target bound.
Which is currently at 4%.
Correct.
And if banks and dealers are paying more than the Fed's target rate for overnight money, what does that tell us about the health of the system?
It indicates a genuine cash shortage, or at least stress in the overnight funding markets. Essentially, financial intermediaries are having trouble getting short-term funding without paying a premium.
So someone is hoarding cash.
It suggests that. Either large institutions are hoarding cash, or there's a shortage of high-quality collateral to secure these loans. It's a structural vulnerability, not a retail concern. And it implies the Fed might soon need to intervene by injecting liquidity.
It's a kind of QE light.
Something like that, yeah. Potentially as soon as early 2026, just to ease that pressure and prevent wider market volatility. It's an institutional headwind that the average trader just ignores.
And they ignore it at their peril. That is a critical constraint on risk. Let's move to segment 3, volatility, the Fed, and the anatomy of the pain trade. The spot VIX is subdued, around 16.6. That's a classic sign of market complacency. But what is the VIX futures term structure telling us that the spot price is hiding?
Well, the term structure, which looks month ahead, is mostly in contango.
Which is normal. Future volatility is priced higher than current.
Right, that's the normal state. And it reinforces that sense of complacency. However, beneath that surface calm, there's a disconnect. The realized volatility was actually a lot higher in late November than the VIX suggests today. And more critically, the curve is showing a subtle steepening in the mid to back end. We're talking the 6 to 9 month contracts. This tells us participants are willing to pay more for long-term tail risk protection.
Okay, so they're pricing in greater uncertainty down the road.
Exactly, for things like policy shifts or geopolitical events scheduled for the back half of next year.
And that uncertainty is made worse by the fragile market consensus.
Yeah.
The market is pricing in an 87% chance of a 25 basis point Fed rate cut next week. That feels aggressive.
It's very aggressive, and that expectation is its primary vulnerability. If we were to get a hotter-than-expected US Core PCE inflation print, and remember, Core PCE is the Fed's preferred gauge.
Because it strips out food and energy.
Right. If that number comes in hot, it directly challenges that consensus. A hotter print, paired with some persistent hawkish Fed talk, just reinforces the higher-for-longer narrative for borrowing costs. And if the Fed stays restrictive into 2026, it detonates the market's primary assumption.
And that detonation leads directly to the pain trade. Who gets hurt here? Who's exposed?
The pain trade is always where the consensus is most crowded. And right now, that is the long position in equities, particularly high beta growth in tech stocks.
Because their valuations are entirely based on low rates.
Entirely. Valued based on the assumption of aggressive Fed rate cuts happening soon. If those cuts don't happen or get significantly delayed because of sticky inflation, these positions leveraged and crowded will unwind and unwind rapidly.
So the selling pressure would be intense.
Intense and protracted. It would lead to a very deep market rotation.
Okay, moving to segment 4, let's talk portfolio mapping. Traditional correlations are just not reliable anymore, which complicates risk management. So how are different asset classes decoupling today? What is the divergence checklist telling us?
We're running a three-way check. Equities, the dollar, and bonds. Equities are cautiously risk-on. The S&P is up a bit. Nasdaq's up a bit. The DXY, the dollar index, is weakening, which typically supports a risk-on move.
Right. Money flows out of the safe haven dollar.
But here's the critical warning flag. The 10-year U.S. Treasury yield is stable at 4.11%.
Which is counterintuitive.
It is. If this rally were truly driven by aggressive rate cut expectations, that yield should be falling sharply as bond prices rise.
Its stability tells us something is wrong.
It signals that the market is internally conflicted. Either inflation expectations are stickier than equities think, or there are some major supply dynamics preventing yields from falling. It introduces an inherent fragility to this equity rally.
And what about the indices themselves? Are ES, NQ, and RTY all moving in lockstep?
We are on high alert for divergence there. If NQ, the tech-heavy index, is making new highs, But RTY, the Russell 2000, which is our small cap barometer for broad economic health, is lagging or even turning lower.
Leadership is extremely narrow.
Exactly. The rally is concentrated in a few mega-cap names. It signals that broad participation and deep risk-taking are getting weaker.
And that really brings us to the biggest structural problem for traditional allocators, the breakdown of the 60-40 portfolio.
Absolutely. For decades, that negative correlation between stocks and bonds was the pillar of diversification. But if inflation proves sticky, forcing the Fed to keep rates high while growth slows, we enter a positive correlation environment.
The bad news is bad news regime.
That's the one. Both assets could sell off at the same time, decimating traditional diversification strategies. It's a huge challenge for portfolio managers.
This fragmented landscape means just relying on broad beta exposure is probably a losing strategy.
Oh, it is. It rewards highly specific active securities selection. I mean, that's the entire point. The headline S&P 500 number can mask profound underperformance just beneath the surface. Intra-equity correlations are fragmenting. Stocks in the same sector aren't even moving together anymore.
So you need factor-based strategies, superior stock picking,
It's the only way to generate alpha in this environment.
which flows perfectly into segment 5, the institutional alpha thesis. So if the market is neutral, but it's rife with all these subtle tensions, what is the high-conviction institutional strategy that navigates both the fragmentation and the fragility?
The core thesis is this: long dispersion, short fragility. It's a strategy built to profit from relative value while hedging these systemic risks efficiently.
Okay, let's unpack the 3 prongs of that. How does one go long dispersion?
That is long idiosyncratic equity alpha. Basically, we implement market-neutral long-short strategies. Because correlations are breaking down, we can go long the fundamentally strong names and short the fundamentally weak names, all within the same sector.
And that neutralizes the overall market risk.
Correct. It neutralizes beta risk and allows you to capture mispricings, the dispersion, purely through stock selection.
And the second prong. How are institutions efficiently going long volatility?
By targeting the mid to back end of the VIX futures curve, specifically the 6 to 9 month contracts. In a contango market, buying the front month VIX futures means you're paying a high price for carry. Those contracts lose value into expiration.
It's a decaying asset.
It is. By targeting the back end, we gain strategic long-term hedging against major policy shifts or elections without incurring that negative carry of the front end. It's just intelligent, long-term tail risk management.
And finally, the short fragility piece, which connects back to that systemic liquidity stress we identified earlier.
That is short targeted credit spreads. Given the rise in overnight funding rates, refinancing risk is elevated. So we target short positions in the most illiquid and risky segments of the credit market, certain sub-investment grade corporate bonds, or some emerging market debt.
Because they're the most vulnerable.
They're the most vulnerable. As funding costs stay elevated, the credit spreads in these fragile segments are likely to widen significantly. That generates alpha, and at the same time, it acts as a valuable partial hedge against the broader systemic liquidity risk.
So, to summarize our deep dive,
Yeah.
we're seeing a cautious risk-on rotation today. It's largely based on the hopeful assumption of imminent rate cuts, but it's fundamentally constrained by serious institutional-grade headwinds, narrowing leadership, fragmented correlations, and undeniable stress in the overnight funding market.
The crucial takeaway is what the consensus is underestimating. The market is pricing in a rapid, substantial series of Fed rate cuts in 2026.
The soft landing.
The perfect soft landing. The reality is that sticky US Core PCE inflation, coupled with the structural funding stress we're seeing, gives the Fed every reason to maintain restrictive policy for longer. And this implies a sustained period of elevated real rates, which corporate earnings and debt servicing costs may not be prepared for. That could lead to a much faster unwind of that pain trade than anyone currently anticipates.
A profound look beneath the surface. For you, the listener, here's your final provocative thought. Which of the structural signs we discussed, the dark pool volume spikes, the persistent creep of the SOFR rate above the Fed's ceiling, or a sudden steepening of the VIX term structure, will you monitor next week to gauge if this cautious risk-on narrative is about to break? Until next time.